We are live from Bloomberg's world headquarters in Midtown Manhattan. I'm Matt Miller.
And I'm Cathie Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, a hawkish Fed, recession risks, geopolitical tensions. As the macro environment fuels uncertainty across risk assets, we'll speak with Cathie Wood's top crypto analyst, Yassine Elmandjra of ARK Invest.
And high hopes for new U.S. crypto legislation this year are fading fast, leaving the industry and investors in limbo. We are live in Washington with Sheila Warren, the CEO of the Crypto Council for Innovation.
Plus, Coinbase in the Google cloud. Details on the company's latest corporate pact after prior deals with BlackRock and Meta.
All right, so all of that is ahead, but first let's get a snapshot of the market. And the best way to do that on your Bloomberg terminal, CRYP Go. That would be your function. And what you'll see is most coins are indeed down on the day, off of the lows of the session as we've seen stocks turning things around, but still Bitcoin down about 0.5%, remaining at that $19,000 level. I feel like I've said that so many times in recent weeks and months. Ether just below 1,300, and you're seeing a bit more underperformance for some of those altcoins, and XRP, one of them, down about 4%. You mentioned the Coinbase story, though, Matt, the partnership with Alphabet's Google on cloud services. That is giving a big lift to the stock today, up about 7.5%, and we're going to have more on that story later on.
All right, in terms of Bitcoin being stuck in a trading range right now, it's really weird because historically it's been an infamously volatile asset. However, it is very interesting to see that Bitcoin is now less volatile than the fiat currencies it is meant to replace. Take a look at this chart. In blue, you see the JP Morgan Global FX Volatility Index. In white, you see the Bitcoin Volatility Index. And indeed, we've seen it stuck in a trading range for so long as FX goes haywire, it's almost like opposite world, Kaylee.
Yeah, indeed it is. All right, let's get to the bigger macro backdrop now and how it is affecting crypto markets. We are joined by Bloomberg cross-asset reporter Vildana Harik. Vildana, obviously there's always a lot of narratives to keep an eye on when it comes to crypto. One of them before was money printer going burr. Now it's money printer going buy. Essentially, it's all about money supply.
I like to say money printer going grr. It's broken.
That also works.
Maybe we can make that meme happen. But yes, if we think about it to all of the narratives that we know about crypto and Bitcoin in particular, it's an inflation hedge, it's a safe haven. But really, those narratives have sort of fallen to the wayside because they haven't really proven true in recent weeks. And the one that we should be paying attention to maybe is just the money supply, M2, the amount of money that's sloshing around in the system.
Or not sloshing.
Or not sloshing in recent months, exactly. So the money supply has drastically gone down, and at the same time, we've had crypto prices really crashing. So there is a bit of a correlation there.
It makes total sense. I mean, right when the white paper came out, we were right at the end of the financial crisis. Ben Bernanke had kicked off quantitative easing, and they were just spitting dollars out of their printing machine. That's kind of the reason we got cryptocurrencies in the first place. Nobody wanted these fiat currencies that were multiplying like rabbits, right? And now you've got the opposite happening. It makes sense that Bitcoin and other cryptocurrency prices would fall.
Yeah, exactly. And the idea basically is that just that marginal dollar, if there's less money in the system, that marginal dollar just isn't going to make its way towards something that's a little bit more speculative, something like cryptocurrencies. And we know that this year, crypto really has been trading in tandem with other speculative assets, including tech stocks, and both have just been hurting as the Fed has been raising rates and as this money supply has gone down.
You said it better than me. Thank you very much, Vildana, for joining us. Vildana Harik here talking to us about what we've seen lately. Joining us now for more is Yassine Elmandjra, blockchain and crypto analyst at Cathie Wood's ARK Invest. Yassine, what do you make of the sort of inverse correlation, money supply and the price of Bitcoin?
Yeah, I think, thanks for having me, first of all, but I think Vildana hit the nail on the head. Uncertain macro environment here is still weighing heavily on Bitcoin's outlook and the crypto market's outlook broadly. And we're seeing, despite these potential signs of recession, that the Fed's still committed to tightening rates to curb inflation, lowering that money supply. And that's effectively negatively impacting all risk on assets, including crypto. So I think until we see a Fed pivot, the markets are, especially in the crypto markets, are likely going to remain choppy.
Well, if they remain choppy, I'm just wondering if that actually means a breakout of the range we have seen for about 4 months now. Matt was just talking about how all of a sudden this seems like a boring asset class almost, and that volatility has disappeared and we just remain in this range around the 20K level. Is it more likely we get a breakout materially to the upside or to the downside?
That's a good question. So we are seeing that Bitcoin's finding resistance at its 200-week moving average and support above its investor cost basis. So we have seen volatility drop significantly. I might actually take the other side and say that low volatility in Bitcoin might not necessarily be a good thing, especially if it's on low volume. If you look at in 2018, we sort of seeing very similar things towards the late 2018. Bitcoin was hovering at $6,000. We saw a massive volatility squeeze. Everyone thought we were going to get a short squeeze. It turns out we dumped to $3,000. So while volatility is, the low volatility is perhaps an indication that Bitcoin is becoming more boring and less contrarian, low volatility on low volume might not be great for Bitcoin.
You talked about in your latest Bitcoin monthly report, the cost basis for short-term holders has gone below the cost basis for long-term holders for the first time since the end of 2018. What exactly does that mean? How do you define those two camps? How do you measure them? And what are the cost bases?
Yeah, absolutely. So despite the low volatility and this Fed tightening, we're actually seeing pretty strong holding behavior across the board. And one of the indicators that we saw, which was the short-term holder cost basis crossing beneath the long-term holder cost basis for, again, the first time since late 2018. A short-term holder cost basis is defined as holders that haven't moved their Bitcoin. I'm sorry, long-term holder cost basis are defined as holders that haven't moved their Bitcoin in at least 155 days. So around that 6-month mark period. And we've seen that the short-term holder cost basis is now below the long-term holder cost basis, which is a sign of much lower speculative behavior. And that short-term holders have capitulated. This is only the 4th time in history.
It looks like we may have lost Yassine there for a minute, Matt.
Technology almost failed us. Yassine, are you still there? I'm wondering if you count Satoshi as a long-term holder, because his cost basis was very low, and of course he's never moved like 1 million coins.
That's correct. Satoshi is considered a long-term holder. I'm sorry, I may have lost you guys there. A long-term holder is defined as a holder that hasn't moved their Bitcoin in at least 155 days, so around that 6-month mark. Satoshi not having moved his Bitcoin in 12 years is considered a long-term holder cost basis. This cross is indicative of short-term holders capitulating or aging into long-term holders. And the last time we saw that was in late 2018 when Bitcoin dropped from $6,000 to $3,000. So usually a sign of a strong market bottom.
Well, you've talked about the bottom. Let's talk about the highs. You were tweeting back in June. I was going through your Twitter feed earlier, essentially saying when we come out the other side and reach all-time highs, it's going to feel a lot better. And you said to block out the noise and focus on the fundamentals. Can I just ask honestly what fundamentals you're referring to when we're thinking about crypto assets? Because we so often say it's much more about technicals because you don't have earnings or anything like that.
That's a great question. I think the beauty of Bitcoin's blockchain being transparent is that we can actually dissect the network activity and the inner economics at any given time. So you can think of the Bitcoin blockchain as almost this global fact sheet that allows for you to assess buyer and seller behavior. And we're seeing pretty strong fundamentals across the board around network activity. If you look at transaction volumes, for instance, ranging around $40 billion a day settled on chain. We're seeing long-term holder supply now exceeding around 14 million Bitcoin. So that suggests that over 66% of Bitcoin supply hasn't been moved in over a year, suggestive of again, strong holding behavior and long-term conviction. These are all accessible on the public blockchain. We publish a report every month that dissects some of this network activity and have been very optimistic at some of the stronger holding behavior that we've seen despite this massive sell-off.
Speaking of optimism, ARK has a call out there that the price of Bitcoin could exceed $1 million by 2030. Do you still stand by that?
Absolutely. I think when you look at Bitcoin as a strategic asset, non-sovereign, censorship-resistant money competing against, central banks and fiat currencies, Bitcoin's supply being capped at 21 million, I think there's an arms race, especially as we shift from the physical to the digital world, to be in assets that are sort of independent of the traditional financial systems and traditional asset classes. When we look at Bitcoin's potential, we segment it across several use cases, everything from it competing as a digital store of value to a settlement network to insurance policy against arbitrary asset seizure. And the beautiful thing here is that Bitcoin's use cases are additive. So for every Bitcoin that's being used as an insurance policy against arbitrary asset seizure, it can't be used as a global settlement network. And so when you sort of create and stack every use case one on top of the other, you come to about a $28 trillion opportunity, which translates to more than $1 million per Bitcoin.
All right, well, we're counting down just 7 years, 2 months, and 20 days to go. Yassine, thanks so much for joining us. Yassine Elmandjra there of ARK Invest.
All right, well, coming up, we're going to get to the regulation conversation, Matt. We're going to be speaking with Sheila Warren, the CEO of the Crypto Council for Innovation, who will be joining us from Washington.
Plus, Coinbase and Google Cloud partner up. We're going to give you more on that agreement ahead.
And, of course, to access all of the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg. Just a very generic question. Why is this so hard? Why has progress on the regulatory front been so elusive in the U.S.?
Well, I think it's really because this is a type of asset class we've never seen before. And so the idea that we could somehow port rules that exist to regulate other species directly over into this ecosystem has turned out to be false. That's not the case. And so while we're simultaneously educating and wrestling, even here in industry, the pace of innovation is so fast.
Yeah.
So trying to keep pace with what's happening, right, is really, really hard.
Well, Sheila, you say that you can't apply the same rules, and yet we just had a report out from the Financial Stability Council today essentially saying countries should be thinking about crypto like they regulate Wall Street, that essentially the same level of regulation of crypto assets and their intermediaries as they are equivalent functions in finance. Why is that not the appropriate view?
So again, I think that the frame on how you regulate and whether to regulate is a country-by-country analysis. And we certainly feel that the time has come for some regulation to enter into the space, for sure. But what is that exactly? How do you think about centralized systems that have traditional intermediaries and things like this? How do you apply rules that work there to a situation where that's not always the case? Again, it's really complicated, not at all obvious how you do that effectively.
You started the digital assets team at the World Economic Forum. You started your career at Cravath, Swaine and Moore after graduating magna cum laude at Harvard. And all of this just to say that you're not some crazy digital revolutionary upstart, right? But
Fair.
You must be concerned about how far back the U.S. is when you look at other countries, when you look at regulation around the world. We're not really keeping up, are we?
I couldn't agree more. I think it's a real concern that I do have. We're seeing not just Europe. Europe is, at this point, lapped us miles ahead with their markets and crypto asset legislation that is now final language being implemented. You've got South Korea, you've got Australia, you've got India. A lot of these jurisdictions, the UK, really all landing that they want to be big players in this space. And the US, I think we have the intention, we're just not quite getting it over the line.
What needs to be done first and foremost? I mean, I look at something like Tether, which, crypto people absolutely love almost religiously, but Wall Street people say, we can't see what's behind this. We don't have the transparency that we need. Why aren't we getting this immediately?
Well, I think there's a question around what transparency actually means in this space. And I would say, I'd kind of point out that transparency doesn't necessarily lead to any kind of accountability or even any ability to understand what's going on. Just because you can see something doesn't mean you know what it means. So part of what I think we're asking for here is when we think about consumers, how do consumers make sense of all of this in a way that is meaningful to them? We don't need everybody to be an expert in blockchain technology, but how do you make sense of what's actually happening while still preserving the innovation space and making sure that this industry, which again has got some brilliant minds in it, far more brilliant than mine when it comes to the technical part of this thing, are able to kind of keep building and keep growing and keep experimenting in ways we think are really important to create a more comprehensive, robust, safe, secure financial system for everybody.
How do companies navigate that if, to date, the regulatory stature seems to be just regulation by enforcement, where decisions are being made that you're punished for that you wouldn't have necessarily known in advance? I mean, how do the companies you work with operate under that?
Well, I think you nailed it. It's really, really hard. It's hard to take a step, especially a big, exciting experimental step, when you don't know if you're going to get slapped, not only with a big fine or even shut down, but the public opinion. So I think there's a lot of frustration that the United States does not seem to be supporting innovation in the way that other countries are. We've had other countries have regulatory sandboxes. You can come in and have a conversation with your regulator, your possible regulator, to tell them what you're doing, what you're up to. And here instead what we've seen is just, like you say, regulation by enforcement approach, where you kind of guess and then you hope you're right, and that doesn't really lead to great decision making by anybody.
So how do you work?
When you don't have clarity.
How do you at the Crypto Council then work with someone like Gary Gensler, who we thought might be a champion for innovation in digital assets, and yet has chosen this path, enforcement rather than working with the industry? How do you go and deal with him or with his people?
Well, our approach is to meet everyone where they are, and certainly an agency, like an industry, is not monolithic. There are different people with different views. So while, yes, there is Chair Gensler with his views, there's Commissioner Peirce with her views. The same thing applies at the CFTC or the OCC. And views change over time as people learn more about this technology, as they get more involved with it, with the opportunity here. So our ultimate goal is to say, what is the mandate of the agency? Is it to protect consumers? Is it to support innovation? Is it macroeconomic stability? And we kind of start there. Like, what is the goal? What is the policy goal? And how can this industry actually help support that goal ultimately?
All right, Sheila, thanks so much for joining us. Really appreciate you stopping by the Washington Bureau. Maybe next time you come to New York, or Kaylee and I will go and meet you in San Francisco. Sheila Warren there, Crypto Council Innovation CEO. By the way, be sure to check out our Bloomberg Crypto podcast, which dives deeper than the daily market buzz to explore how this asset class is changing the way we live. Look for that every week through the Bloomberg Professional app, iHeartRadio, or wherever you get your podcasts. This is Bloomberg.
This is Bloomberg Crypto. I'm Kaylee Lines with Matt Miller. Now to some crypto stories that caught our attention this week. BNY Mellon is diving deeper into crypto. The firm has launched a digital asset platform in the U.S. that will allow some clients to hold and transfer Bitcoin and Ether. It comes after a survey they conducted that found 41% of institutional investors hold cryptocurrencies in their portfolios.
And the amount of computing power dedicated to Bitcoin mining has reached an all-time high. After the upgrade of the Ethereum network, companies made use of the excess energy and data center space. A higher level of computing power will lower mining revenue for Bitcoin miners who are already battered by low Bitcoin prices and, of course, the soaring cost of energy.
And Coinbase has selected Google as its cloud provider. The two companies announced a new long-term strategic partnership earlier today. Coinbase will use Google's cloud platform to process blockchain data at scale and build advanced exchange and data services. And as a result of that, Coinbase is up about 7%, Matt. But this is just another example of them partnering with a big company outside of the crypto space, like with BlackRock, for example.
Yeah, absolutely. And I think it also adds to the institutional story, which is, for me, the most interesting thread here, that institutional institutions continue to be interested in and are building on that interest in cryptos. So that's a very promising sign for the future, even if retail investors are forced to sell at a cost below the one they bought in at.
Yeah, and maybe that's why we've seen a stabilization of shorts in the crypto market. All right, that's going to wrap it up for us here this week. But come back next Tuesday at 1 p.m. We'll be talking with the co-founder of Magic Eden, a rival to OpenSea and the biggest NFT marketplace on Solana. From New York, this is Bloomberg.